Hey everyone, me Kevin here. Alright, office is still a mess, but I owe you an update on Tesla. Tesla had absolutely phenomenal earnings this week, and it's actually down on the week. Well, we've got to talk about this, and why I believe that if it weren't for the Federal Reserve this entire month, Tesla would have already surpassed $1,600 per share this month. It obviously hasn't, but let's talk about where my thesis is and my response to the folks who say Tesla is just an extremely overvalued company. It's a dumb company to invest in and it's way too risky. Let's talk about that, because I think it's way too risky not to invest in Tesla. Okay, folks, first, this is not financial advice. These are my opinions. Second, most companies have a single product or line of products that are extremely innovative and useful to customers. For example, take Adobe. We love Adobe. Adobe Premiere, Adobe Photoshop, Adobe Lightroom. But once you acquire customers with an amazing product and you grow for many years in a row, what do you do once you've acquired them? Well, you try to prevent people from leaving to different services, like maybe going to Final Cut on the Mac and no longer using Premiere or whatever. Well, at the same time, maybe the company will continue to update their software to minimize people leaving and providing more competitive elements. But really, at some point, after you grow, after you have your first sort of blow up, your exponential growth, like, oh my gosh, everybody's using PDFs. Remember, PDFs are a creation of Adobe's, woo! You get this big growth curve. It almost seems exponential, but because of the law of large numbers, exponential can't go on forever with businesses, so you tend to have a leveling off. And this is what we call the S-curve. Slow growth at the beginning of a business, exponential growth at the boom of a product or service, and then a capping out. And to add growth, you end up having to add new types of businesses, like analytics for ads, something that Adobe is doing. And that's great. It is now helping Adobe achieve a Wall Street forecasted average growth rate of 12% for the next 5 years. Its projected earnings this year are $13.7, which means at $408 per share, its closing price today, April 22nd here, Adobe sells for 30 times earnings. Simple. All we did there is divide the price by $13.07 of earnings. Boom, you get 30. That's a multiple. It's a P ratio. It's like a gross rent multiplier, or once you get down the line, more like a net rent multiplier. But don't worry so much about that for those real estate folks. They'll know what I mean when I say GRM. Now, another cool thing that you can do, though, is you can take this growth rate, and we're going to do this with Tesla as well, that the company's growing at, which is 12%, and actually divide the multiple that you're paying for the company by the growth rate. So if you take 30 times earnings that the company's selling for right now and divide it by the growth rate, you get the PEG ratio. In this case, that would be 2.19 approximately, because you're dividing 30 by a growth rate of about 12. Okay, makes sense. Now, this is also when most people look at the chart of a company like Adobe and say, oh, Adobe, I'm paying about 2.19 in terms of a PEG ratio, 30 times 2022 earnings. It's down 27.5% this year to date. If you go out 12 months, it's down 20%. So in other words, it's been on a large downtrend. And some folks might look at this and say, hey, here's an opportunity to buy Adobe at a discount. But wait a minute, discount to what? A euphoric stock market, or is there some spectacular new innovative growth coming to Adobe? See, here you're buying a falling stock with a 30 times earnings rate and a PEG ratio of 2.19 thanks to the 12% growth rate. So you're investing in Adobe for 12% growth and you're paying 30 times earnings for that. Okay, These folks might then also think, well, using similar metrics here, if we just look at price to earnings, Tesla is ridiculously overvalued. I mean, $1 trillion company for an auto manufacturer, that seems crazy. And this is unfortunately where most investors completely misunderstand stocks, margins, and Tesla. See, Tesla has phenomenally high margins, and margins that are shockingly growing during inflationary times. Imagine when we don't have inflation and how much margin expansion we could get. We thought 30% in margins could be good, but when you get things like the Cybertruck, we might actually be knocking on the door of 35 to 40% margins. But forget about that for a minute. forget about the fact that the company is becoming much more efficient than any car company to have ever existed before. Tesla today almost entirely is a car manufacturer, and at this point, if we stack up the numbers of Tesla versus Adobe, we find that Tesla has an earnings per share of an estimate of about 15.9 this year. At $1,000, that means it's trading for about 63 times earnings. That's more than twice Adobe's valuation, right? Seems like a ripoff. Like Adobe was trading for 30 times earnings. Why am I paying 63 times earnings for Tesla? Kevin, you just proved yourself. It's a ripoff. Well, you're gonna miss the boat if you're not already thinking what I'm thinking. But before I tell you what I'm thinking and my response, we've got a message from a great sponsor today. Here it is. Thank you to today's sponsor, ScoreMaster. ScoreMaster helps people take control of their credit and gives you the tools to boost your credit score quickly and easily with a custom plan. I always talk about how important your credit score is to real estate investing after all, and I think we got some opportunities coming up. And if you want to get the best deals and the best interest rates, you gotta have a good credit score. You know this. And it can be really confusing to understand everything that goes into a credit score. So thankfully, ScoreMaster makes it simple. On average, members who use ScoreMaster add 61 points in 20 days or less to their credit score. Unlike other credit monitoring platforms, with ScoreMaster, you could take actions on your credit and get results at the push of a button. They hold 4 patents for this technology that allows you to communicate directly with your creditors, who then notify bureaus on your behalf. No more sending letters or waiting on hold, making freaking phone calls. See, the biggest mistakes I see people make in real estate investing is not getting started because they have bad credit, because they can't secure loans, the loans they need to get into real estate. Well, ScoreMaster not only allows you to easily and quickly boost your score, but you can protect it as well. Don't wait to start building your credit. Go check out ScoreMaster in the link in the description down below to get my special pricing. Okay, so I left off mentioning that Adobe is selling for about 30 times earnings and Tesla is selling for 63 times earnings, which makes it seem like you're paying almost, well, actually a little bit more than 2 times the valuation for Tesla as you are Adobe, right? Because, you know, they're selling for a PE of about 30 and the Tesla's right around 60, 63. But wait a minute, Adobe's growing at 12%. How does that compare to Tesla? Well, Tesla is actually growing at more than 50%. If you believe what Elon said, and that's average over the next 4 to 5 years, unless of course all of a sudden consumers decide they hate Teslas, that would be a big risk factor, right? If consumers all of a sudden decided they hate Teslas, I promise you this, Tesla will crash faster than a Model S Plaid carrying Netflix's earnings. That's really bad. But wait a minute. 60% growth is literally 5 times the growth of Adobe for only twice the price. So you're getting 5 times the growth for twice the price. And you're paying a PEG ratio of about 1. Because again, you take that PE ratio, 2022 PE of about 60 to 63, divided by the growth rate of about 60, that's about 1. So you're paying twice the price to get 5 times the growth. You're getting less than half on the PEG ratio. This actually, in terms of a growth stock, makes Tesla a bargain. That makes Tesla at least 2.5 times more attractive than Adobe. Now, some folks might disagree with that. Again, if people stop buying Tesla cars, you've got a big problem. But now we got to think about the S-curve of demand for Tesla because, see, Tesla is more than just a vehicle manufacturer. It's really a holding company. If you think about it, there are 4 major other S-curves that we haven't even talked about. And I'm not even considering the Cybertruck or semi-truck. No. Those are all part of the cars businesses. It's all part of the big 5 businesses, the cars and the 4 others. Think about the big businesses they have. Number 1, cars. Duh. High margin cars, high quality cars, some of the safest cars to ever exist on the road. That's number 1. And everybody wants one. Number 2, full self-driving, chips, AI, and autonomy. It's almost like, and I know this sounds a little crazy, but it won't be crazy in the future, I expect. It's almost as if Tesla has its own Qualcomm and NVIDIA in its portfolio that it's holding. That's because Tesla makes incredible chips in-house. They're not making chips for you to play video games or for you to play, Bitcoin. They're a chip maker to learn real-world artificial intelligence, to train neural nets, and to make our cars more efficient, use less power, react quicker, better, faster, and, of course, more efficiently than ever before. See, they're an AI developer and a chip maker. If you want chips to mine, again, Bitcoin, or you just want a regular AI developer and chip developer, I think in the future, NVIDIA and Qualcomm are going to be great companies. Maybe at some point, NVIDIA, with their partnership with Lucid, will bring out some form of a lane keep assist. They have a partnership, so we'll see. But see, Tesla's not just a car company. It's a car company and a chip company and an AI company. That's business one and business two. Think of business three, a battery and energy company. They're making their own supply. And number four, they're an insurance company. One of Warren Buffett's greatest home runs, at least as told by his biography, Warren Buffett and the Snowball of Wealth, one of his greatest home runs was going heavy in on Geico early. And you might think, oh, but it's too late for Tesla, right? I don't think so. Because then you've even got business number five, robotics. And I think an easy way to visualize this and how impactful these S-curves could really be in the future is really by understanding the power of being a battery maker and an AI developer and a robotics manufacturer. We think that the car business is everything. That's it. Once the car business is, hits the top of its growth curve, it's over for Tesla. But see, the beautiful thing is, and I saw this from Value Analyst number one on Twitter. This is somebody that I met at the Giga Rodeo parties in Austin, Texas. Cool guy. Take a look at this, folks. I think you'll like this. What we're so used to as the S-curve is right here. This is your electric vehicle S-curve. Now, I might disagree with the size of some of these, but what Tesla is actually a company that has compounding S-curves. And right now, you're only paying for this green section right here. That's what you're paying for. You're paying for the green. That means you're getting FSD and robotaxi for free. That's the self-driving, the FSD, the chip side, right? That means you're getting a battery manufacturer, potentially even here in the future, a lithium miner. We'll see what Elon ends up pulling out of his hat. You're getting an energy company essentially for free. But look at the biggest of the S-curves. That's almost like investing in the best possible robotics startup ever, folks. AI robots. It's not just manufacturing robots that Tesla can sell or license. It's the future of robotics in our homes, the Optimus. These are the things that you're betting on with Tesla. You're not just betting on electric vehicles. And quite frankly, even if you were betting on electric vehicles, Tesla is 2.5x more attractive than Adobe, thanks to its phenomenal growth perspective. Again, if you don't believe in the growth perspective, don't invest in Tesla, because we can't yet value FSD robotaxi, because we just haven't seen it full scale. Although I watch FSD videos every day and I know it's getting better and better and better. One day I'll get an invite to FSD. We know the battery business is getting better and better and better. And they're probably, the folks over at Tesla are probably some of the most brilliant minds for battery engineering. And then of course that Optimus robot. So long story short, I'm really happy. I am super heavy in on Tesla. And all of this nonsense right now with the Federal Reserve is creating a delicious short-term buying opportunity. We'll see you on the other side of this madness. And your goal is, not financial advice, how many Tesla shares can you stack up? See you in the next one. Bye.